Hey guys, what's up? Alec back with the daily stock market, and look at that, we have Palantir down 2%. Now let's do a little bit more of a deeper dive on Palantir to see if it's a good deal right now. You can see it's down 14% in the past month and around 30% in the past 3 months. All right, we can see a swing trade. Looks like it's being set up here, and a sell around $25 per share could be accurate. Let me know if you guys like the deeper dive videos when I focus on like 2 or 3 different stocks throughout the video, or let me know if you guys like the rapid fire a little bit better when I go over like 10 or more different stocks in one different video. So here you see Palantir Technologies Inc. shares have lagged the S&P 500 in 2021, generating a year to date a total return loss of 21% year to date. Palantir stock has had a wild ride this year, but many investors may wonder whether there is any value to be found in Palantir shares after the sell-off. Earnings. A price to earnings ratio, PE ratio, is one of the most basic fundamental metrics for gauging a stock's value. The lower the PE, the higher the value. The comparison, the S&P 500 PE is about 30. All right, so if you can get a PE under 30, that's implying it's a good deal. However, the S&P is nearly doubling its average, its long-term average, which is typically around 15 PE. Palantir doesn't have a PE ratio because the company's not profitable. In the recent quarter, Palantir reported $100 million net loss. Growth. Looking ahead to the next 4 quarters of S&P 500 4P ratio looks much more reasonable at just 21. All right. Palantir forward earnings multiple of 91 is more than 4 times the S&P 500, making Palantir look overvalued. Palantir forward PE ratio is also more than 3 times the average multiple of its technology peers, which are averaging around a 21 forward PE ratio. All right. Yet, when it comes to evaluating a stock, earnings aren't everything. The growth rate is also critical for companies that are rapidly building their bottom lines. The price to earnings to growth ratio, or the PEG ratio, is a good way to incorporate growth rates into the evaluation process. The S&P 500 overall PEG is about 1.0. Once again, without positive earnings, Palantir does not have a positive PEG ratio to use the valuation gauge. The price to sales ratio is another important valuation metric, particularly for unprofitable companies and growth stocks. The S&P 500 price to sales ratio is 3.2, well above its long-term average of 1.6. Palantir PS ratio is 25, nearly 8 times the S&P 500. However, Palantir's PS ratio is also roughly down 14% over the past year, suggests the stock is priced at the low end of the historical value range. Finally, Wall Street analysts see value in Palantir stock over the next 12 months. The average analyst price target among the 8 analysts covering Palantir is 24.50 cents, projecting about a 35% upside from its current levels. All right, so that's what we were talking about. A little bit of a swing trade up to $23 or $25 could be beneficial. However, I don't think it'll take 12 months. In my opinion, it'll probably take closer to 6 months. All right, the verdict. At today's price, Palantir stock appears to be overvalued based on the sampling of common fundamental valuation metrics. Palantir stock was trading at $18 on Wednesday, down 2.8% on the day. All right, so the next stock I want to talk about is Disney, and Disney's down 11% in the past 3 months and 13% over the course of a year. It was even as low as $140 at one point. I have a lot of money in Disney, probably close to $6,000, most of it in my long-term accounts, okay? But we've seen Disney around $150 per share in 2019. Remember, it added Disney Plus and many other great things. So I think that Disney is going to have multiple years of growth over the next couple of years. It's easy stock to just buy and hold for long-term, in my opinion. And here we'll see an article, Disney is the Dow's biggest loser. Can the book of Boba Fett help the stock bounce back? Walt Disney stock has been the worst performer of the Dow Jones this year, while the company's grander streaming ambitions hit a few snags. A trove a new content could propel shares in 2022. All right, the first episode, The Book of Boba Fett, a live-action Star Wars series on Disney Plus, dropped on Wednesday. Disney stock was mostly flat on Wednesday, in line with the broader market. Shares are down 14% year-to-date compared to the S&P 500 index, which is up 27% in gains. It's also the Dow's biggest loser of the year, but whether that's a positive or negative sign for 2022 depends on your sample. In November, Disney reported slower than expected subscriber growth that sent shares tumbling. Still, the company maintained its fiscal 2024 target of up to 260 million subscribers on Disney Plus, up from 118 million in September. The stock's bulls liken the short-term disappointment to Netflix, which has in the past bounced back from temporarily slowdowns in growth. If you're more concerned about estimates than historical trends, 21 out of 30 analysts listed by FactSet have a buy or equivalent rating on Disney stock. That means price target of $193 implies a 24% upside for Disney. We believe Disney's positioning in streaming is likely to drive multiple years of rapid growth, and profitability should improve as the theme park and film business recover post-COVID-19, he wrote. This growth should more than offset the pressure on legacy media networks, in our view, and makes Disney a leader in an evolving media landscape. And we can confirm that we have the analyst. We have 21 different analysts with a 26% upside in the next 12 months to around $196 per share. Again, I think that could come a little bit quicker than that. And I think $220 per share in the next 12 months is achievable for Disney. Here you can see some analysts coming in, reiterating 16, 17 days ago, and they have 210, 216, and $285 price targets for Disney. So Disney is definitely a stock that I am loading up on pretty heavily right now. And the last one we're going to be talking about in the video today is going to be Ford Motors. All right, a lot of people are asking me about Ford, so let's talk about them. Not moving much in the last month, but in the last 3 months, they're up 42%. And the last year, they're up 130%. They were around $9 per share earlier this year. And in the last 5 years, they're only up 65%. We saw them take a dive all the way to $4 to $5 per share when we were investing in Ford. Founded in 1903, one of the oldest companies in the stock market. They also have a market cap of $82 billion, which is huge, a volume of $37 million, and a PE ratio of 28. Here we can see an article that says Ford is more valuable than GM for the first time since 2016. Ford Motor has had quite a year, and investors have rewarded the company with a market capitalization greater than the rival, which is General Motors. All right, Ford closed Tuesday with a market cap of $82 billion. According to FactSet, GM closed with a market cap of $82.9 billion, so it just beat it out. They're pretty much neck and neck at this point. We should do a deeper dive on these two because I would love to compare the income statements, balance sheets, and everything between these two. With a difference this small, exact share counts matter. The share counts are consistently changing based on management stock options, exercise, and other factors. Still accounting for all that, Ford has nipped GM, and here you can actually see a little tweet by Alan Root, and you can see Ford and GM, the comparison since 2016. Understanding how it happened is easy. Ford stock has risen about 136% year to date, which is insane. GM shares have gained only 37% so far in 2021. Both returns exceeded the 28 and 20% comparable respective gains, the S&P 500 and the Dow Jones average. GM stock has done fine, but Ford stock has simply lapped its peer. Ford has been playing catch up and is essentially in a turnaround, being led by a new CEO, Jim Farley. Coming in 2020, Ford shares have lost about 30% of their value over the preceding 3 years. GM stock has gained about 2% over the same span. The companies seem to be getting more credit for its vehicle electrification plan. Ford has made a splash this year, launching its all-electric Mustang Mach-E, developing its all-electric F-150, and announcing plans to spend billions on new capacity for batteries and electric vehicle assembly capacity. GM has, however, done the same exact thing, announcing billions in spending on batteries, battery materials, and EV assembly capacity. GM is also now selling the all-electric Hummer truck and is planning to unveil an all-electric Chevy Silverado in coming weeks. Don't forget, GM sells more electric vehicles than Ford worldwide, including Chinese joint ventures. All right, so this article is actually, this whole thing is to get you thinking a little bit about where you're going to invest your money. And GM honestly might be a better deal than Ford. I would love to do a little bit more of a deep dive on these two. The strategies feel the same, but the market is a little uneasy about GM. A couple of factors could be at work. The Chevy Bolt EV was recalled because of a battery defects. The defects was traced back to a supplier. There have also been problems at GM's autonomous driving company Cruise recently. CEO Dan Ammann departed abruptly, likely because the difference between Ammann and GM CEO Mary Barra over the strategic direction Cruise should take. The market might be correct in saying Ford has the better year, but underperformance can, in the right conditions, be an opportunity. If GM can get the Bolt and other electric vehicles shipping, successfully launch the Silverado, and make progress on its own autonomous driving features, then the stock should do just fine. Ford stock is trading for about 10 times estimated 2022 earnings. GM stock is trading at about 8 times that number. If GM was to trade for 10 times earning, it would be a $72 stock, and its total return going back to the end of 2017 would be about 75%, which is very close to Ford's total return. So GM is definitely a very interesting stock as well, only up 7% in the last 3 months and only up 36% in the last 1 year. All right, for a long time it was hanging out around that $40, $30 mark, and it fell as low as around under $20 per share in recent years. We have a PE ratio on GM of only 7.63, implying it is a great deal for long-term holders. If we look what analysts have to say about GM, by the way, they have clocked in a 30% upside over the next 12 months, and some analysts have them as high as $90 per share. All right, some of these analysts even reiterated this just 8 days ago, 10 days ago, so you can actually see where they're coming in from. And Daniel Ives, a top 25 analyst from Wedbush, actually has an $85 price target, reiterated 1 month ago, and that's a 12-month price target horizon. I personally think they will be around $75 per share in the next 6 to 12 months. And if we look at what analysts have to say about Ford, they have an on average of 5% downside in the next 12 months, and some analysts have them as low as $12 per share. Here we can see some analysts have them as high as $25 per share. So analysts are really all over the place when it comes to Ford, and I think that GM is actually going to be a safer bet, and it's going to get you the same kind of exposure that you will with Ford. Launching the new electric Silverado down the road with GM, I think that's a better route to go personally. So if you did like that video, smash the thumbs up button, comment below, share this video with a friend if you think that they will find it helpful. Also, if you want to join my close friends list where I show exactly what stocks I'm buying, how much I'm buying, and when I'm looking to sell, and I also post when I sell, message me on Instagram to join my close friends list. If you want to see some success stories, click on success number 4, success number 3, and read through a few of those success stories that many of clients have had now, over 500 positive testimonials on my Instagram highlights. All right, guys, I'll see you in the next video. Remember, don't time the market, buy the market. Peace.